Right now, one of the biggest banks in America, JPMorgan, is quietly preparing for what could be a 500% surge in silver. And the craziest part? This exact setup has happened only 4 times in modern history: 1929, 1971, 1980, and 2008. Every time, it triggered a massive wealth transfer. Today, the pattern is back. Stage 3 is complete, Stage 4 is loading, and almost nobody realizes what's coming. I'm not a financial advisor, this isn't financial advice, this is purely educational analysis based on publicly available information and historical patterns. But what I'm about to show you deserves your attention. Look, I've spent months studying financial collapses throughout history, and what I've found is this: they all follow the same pattern, 4 stages, always. And here's what concerns me: we might be watching Stage 4 right now. Let me break down my thoughts. Stage 1 is what I call the setup. Authorities create what looks like stability. Prices get suppressed. The market floods with paper promises. Everything seems fine. Everyone trusts the system. This is where they build the foundation for what comes later. Stage 2 is expansion. The gap between paper promises and physical reality expands. Debt printing, promises stacked on promises, but prices stay suppressed. People believe the system is working. Meanwhile, underneath, pressure builds. Stage 3 is what I call the break. Something fails. Could be technical, could be political. Suddenly, everyone wants the real thing, the physical asset, not the paper promise. And there isn't enough. That's when people realize the promises might not be kept. Stage 4 is eruption. Price explodes. Shorts get crushed. Institutions positioned early win big. Everyone else is scrambling. And this is where I believe we are right now. This is where history becomes crucial. Let me show you why. Let me tell you about Texas. 1979. 2 billionaire brothers, Nelson and William Hunt. They looked at silver trading around $6 per ounce and saw something others missed: inflation, consumption exceeding production, a perfect storm. So they bought approximately 200 million ounces, around 1/3 of America's entire silver supply at the time. Then January 1980 arrived. According to historical records, silver hit $49.45. That's roughly 800% in 18 months. Banks panicked.
The exchange changed the rules overnight, banned new long positions, forced liquidation only. Silver Thursday, March 27th, 1980. Crash. The Hunts were destroyed. But here's what I think matters most. The squeeze was real. The shortage was real. And that $49 price was real. It literally took changing the entire game to stop it. Think about that for a second. The fundamentals were so strong, the only way to break the rally was to rewrite the rules mid-play. Now imagine something with me. What if the buyers weren't 2 reckless billionaires? What if it was the institutions that help make the rules? That changes everything, because they won't make the same mistakes. They won't squeeze too fast. They won't be reckless. They'll be patient. The Hunts were early. They got crushed. But they were right about the fundamentals. Demand exceeds supply. Industrial consumption is accelerating. Physical reality versus paper promises. All of it was accurate. Their timing and their approach, that's what failed them, not their analysis. And here's what keeps me up at night. What if someone studied their mistakes? What if someone spent decades positioning themselves on the right side of this trade? What if they accumulated quietly, slowly, without drawing attention? That's a very different scenario. That's not a squeeze. That's a controlled demolition. And when it happens, they'll be positioned perfectly, while everyone else scrambles to understand what just occurred. So who learned from the Hunt brothers' mistakes? Who's been positioning quietly for over a decade? Let me show you what I found. And this is where it gets really interesting because we're not talking about reckless billionaires anymore. We're talking about institutions. Big institutions. According to various market reports and regulatory filings, one of America's largest banks has been accumulating physical silver since around 2011. Quietly, consistently, for over 14 years now. Industry sources estimate the accumulation could represent a substantial portion of above-ground supply. Now, I keep asking myself, if silver doesn't matter like so many experts claim, why would a major financial institution be stockpiling this metal? Here's what I understand of what happened. Back in 2010, this bank reportedly settled manipulation charges. When they acquired another institution during the 2008 crisis, they inherited massive short positions. For years, they were apparently on the wrong side of the trade. So what'd they do? According to market observers, they flipped, covered their shorts, went long. Massively long. Think about that strategy for a moment. They learned from the hunts. Don't fight the system. Become the system. Don't squeeze too fast. Accumulate slowly. Don't announce your position. Stay quiet. And most importantly, don't go against the rules. Help write them. Now let's talk about why this matters. The paper market. According to published data, open interest in silver derivatives sits at levels that dwarf physical supply. Some analysts estimate the paper market is around 50 times larger than the physical market. That means if even a fraction of paper holders demand actual delivery, the system faces serious stress. Meanwhile, something critical is happening with supply and demand. Industrial consumption keeps accelerating. Solar panels need silver. Electric vehicles require significantly more silver than traditional cars. 5G infrastructure, AI data centers, medical devices. Industry reports suggest silver demand from industrial sources now represents approximately 60% of total consumption. That's up dramatically from just a decade ago. But here's the problem. Mine production hasn't kept pace. Data from mining reports shows supply constraints. Analysts point to what they call a structural deficit. More silver consumed than mined, year after year after year. So where's the difference coming from? Above ground stockpiles, vaults, reserves. They're being drained. And while this is happening, while industrial demand surges and supply struggles, the paper market kept prices suppressed. Until recently. Every time physical demand increased, reports suggest major institutions flooded the market with paper contracts, short positions, derivatives. According to market data, prices stayed controlled for years. But you can only suppress reality for so long. In my view, the gap between paper promises and physical reality has never been wider. We have surging industrial demand that's not going away. We have declining mine production that takes years to increase. We have structural deficits draining above-ground supply. And we have a paper market built on leverage that some estimate exceeds physical availability by massive multiples. Now overlay that with major institutional accumulation, patient accumulation, strategic accumulation. These institutions aren't gambling. They're positioning. And when you position for over a decade in an asset everyone else ignores, you're not making a short-term trade. You're making a long-term bet on fundamentals, on supply and demand, on the inevitable moment when paper promises meet physical reality. Now, this is where it gets really interesting to me. Accumulation alone doesn't trigger stage 4. We need something else. We need stress. We need cracks in the system. And here's what concerns me. I think we're watching those cracks appear right now. Let me show you what I mean. Exchange outages during volatile periods. Reports of technical failures at exactly the moments when price movement accelerates. When systems come back online, market observers note spreads that shouldn't exist in normal conditions. That's not a coincidence. That's what illiquidity looks like. That's what happens when a paper market faces stress. Then something else catches my attention. Inventory reclassifications. Silver moving from available for delivery to just stored. Think about the timing. During peak physical demand, deliverable supply gets pulled off the table. That tells me something. That tells me the people managing these vaults see something coming.
Here's another signal. Lease rates. When people are so desperate for physical metal, they'll pay extraordinary interest rates just to borrow it temporarily. That's not normal market behavior. That's what a squeeze forming looks like. That's what happens when paper claims exceed physical availability and someone needs actual metal right now. Look at what happened in 2020. Physical premiums hit 60% over spot price. Silver was trading at one price on paper, but if you wanted actual coins, actual bars, you paid dramatically more. The disconnect was staggering. Now imagine that scenario with even tighter supply. Imagine it with industrial demand still climbing. Imagine it with vaults already drained from years of structural deficits. These aren't isolated incidents. These are symptoms. Stage 3 doesn't announce itself with sirens. It reveals itself through cracks like these: small failures, unusual spreads, inventory games, desperate lease rates. Each one alone might be explainable. But together? Together they paint a picture, and that picture suggests the gap between paper promises and physical reality has never been wider. The question isn't if that gap closes. History tells us it always does, eventually. The question is when. So if we're in stage 3, what does stage 4 actually look like? And more importantly, what's the timeline? Let me walk you through this carefully, because I don't deal in guarantees. I deal in historical precedents and current evidence. Remember the Hunt brothers? Silver hit $49 in 1980. When you adjust for inflation, that's approximately $170 in today's currency. But consider this. The supply deficit appears worse now, industrial demand is higher now, and the paper market is exponentially larger now. So what happens when that corrects? Historically, silver has tracked gold at a ratio, for most of history around 15-1. Recent data shows it's currently closer to 72-1. When that ratio corrects, and historically it always does eventually, we could be looking at significant price movement based purely on mean reversion. I'm not saying that's guaranteed, but mean reversion is a fundamental market principle, and it tends to happen eventually. Here's my thinking on timeline. Central bank decisions matter. When rates drop, the dollar typically weakens. When the dollar weakens, historically, precious metals tend to surge. We're watching those policy decisions unfold in real time. That's the spark. The structural deficit is the tinder. Institutional positioning might be the accelerant, and a paper market under stress could be the explosion. What happens when holders of paper contracts demand physical delivery? What happens when they realize there might not be enough metal to cover all the claims? What happens when pension funds, sovereign wealth funds, and retail investors all try to acquire physical metal simultaneously? That's the scenario that concerns me most. Physical metal is still available right now. Premiums are rising according to dealer reports. Some mention delays, but you can still get it. That window might not last. When paper markets face stress, when contracts potentially can't be delivered, premiums could explode. We're talking possibly 30, 40, 50% over spot price, maybe more. I'm not saying this happens tomorrow, but it's probably not 10 years away either. At current deficit rates, at current drain levels, 6 to 12 months, maybe sooner if there's a rush. Here's what I think people miss. This isn't just about silver. Silver is the symptom. The underlying issue runs deeper. Since 1971, when the gold standard ended, currencies have been pure fiat, backed by confidence and economic strength, but not physical assets. And after decades of printing, decades of deficit spending, some economists argue the bill might be coming due. We're seeing it in energy prices. We're seeing it in food costs. We're seeing it in asset inflation everywhere. In my analysis, silver might be the most undervalued scarce asset right now. Undervalued relative to gold, undervalued relative to its industrial importance, undervalued relative to money supply growth. When the market corrects that undervaluation, if it does, the move could be significant. In 1980, silver peaked around $50. It took 45 years to break that record. 45 years of what some call suppression. 45 years of accumulation. 45 years of coiling. The Hunt brothers were early. They got crushed, but they were right about the fundamentals. Now imagine if they had been patient. Imagine if they had the backing of the entire system instead of fighting against it. That might be what's happening today. Institutions learning from those mistakes, not squeezing too fast, not being reckless, just letting the market do the work. And when prices move, if they do, they'll be positioned perfectly. The signals are everywhere. Record prices, structural deficits, institutional accumulation, paper market stress, policy decisions, geopolitical tensions, all happening at once. That's not a coincidence. That's convergence. Stage 1, the setup, done. Stage 2, expansion and debasement, done. Stage 3, the crisis, happening now. Stage 4, the inevitable outcome, loading. You don't have to believe me, but you should study history, and history has a way of repeating. I'm not a financial advisor. I'm just someone who's been studying these patterns, watching these markets, trying to make sense of what's happening. The situation isn't coming. It's already here. The only question is whether you're positioned to understand what's unfolding, or whether you'll look back wishing you'd paid attention. The 4 stages, the historical precedents, the current evidence, it's all there in public data. I'm not asking you to believe me. I'm asking you to look at the same information and think for yourself. Stage 1, complete. Stage 2, complete. Stage 3, in progress. Stage 4, loading. This isn't financial advice. I'm not telling you to buy anything. I'm simply sharing what I found and asking you to study history, because those who ignore history tend to repeat it, usually on the wrong side. If you want to follow along as this develops, hit subscribe. I'll be tracking the evidence and sharing analysis as we watch this pattern unfold. Drop a comment below. Do you see the same pattern I'm seeing? Or am I connecting dots that don't exist? I'm genuinely curious what you think, because one thing I know for certain, whether you believe it or not, history is about to teach us something. Again.